Happy New Year still remains appropriate, but now January is nearly complete, and it's been an action-packed month. The widely followed S&P 500 equity index has closed at several new all-time highs in January, and through the January 28th was up about 1.9% for the month. And market leadership has shifted away from the technology sector as stock market gains have been led by lightly followed sectors, materials and energy, as well as small company stocks. Domestically, consumer confidence has weakened, but inflation expectations have decreased, and the outlook for consumer spending remains positive. President Trump has made tariff threats on Europe tied to Greenland and on Canada and South Korea tied to trade negotiations. The US dollar has weakened, and gold and silver prices have continued to surge to record levels. And markets still await a Supreme Court ruling on the legality of tariffs imposed in 2025. U.S. Treasury yields, or interest rates, have moved modestly higher in January, but the Federal Reserve Bank, or Fed, held its first 2026 monetary policy meeting this week and left its short-term Fed funds interest rate target range unchanged at 3.5% to 3.75%. But underlying all of the market-moving activity to start the year are solid economic trends. U.S. gross domestic product, or GDP, growth strengthened in the second half of 2025, and the economy is supported by early 2026 catalysts as well. Late 2025 economic data was largely delayed due to the October-November government shutdown, but slowly the reports are becoming current. GDP growth in the third quarter was up 4.4% annualized, the strongest quarter in 2 years, and it was bolstered by consumer spending, business investment, and exports. Official fourth quarter GDP data was delayed until late February, but as the monthly data is reported for October, November, then December, the early read is positive. Consumer data has been complicated because low-income consumers feel the cumulative impact of inflation over the past several years. In recent months, wage gains have exceeded inflation, but it hasn't been enough. And those same consumers, though, appear to be spending. And this is perhaps bolstered by lower savings rates and more borrowing or credit. But high-income consumers have sustained high spending levels, likely bolstered by investment gains. Business investment data throughout 2025 was also very positive, with record levels of investment on artificial intelligence, or AI, and data centers. While the Wall Street Economist consensus estimate for 4Q 2025 GDP growth is 1.2%, the tracking model GDP Now estimate from the Federal Reserve Bank of Atlanta, which registered the impact of reported data only, shows the economy is better than expected. The GDP Now model for the fourth quarter has ranged between up 3% and 5% plus in January. This can be volatile as monthly updates are inputted, but we believe GDP for the quarter will ultimately be reported well above that 1.2% estimate. This is in a quarter then also where the fourth quarter that included a 6-week government shutdown that disrupted travel and weighed on consumer confidence, and also a choppy jobs market. The Fed's interest rate pause was expected, as the reason for cutting interest rates would be to stimulate a weak economy, which was not evident. The Fed commented that the U.S. economy appears stronger in January, even since the previous Fed meeting 6 weeks earlier. The U.S. economy in the early part of 2026 should be supported by solid consumer spending, as the financial positions of high-income groups remains healthy, and low-income groups will get an expected boost from tax refunds and lower withholding created by last summer's budget bill, the One Big Beautiful Bill. And that same bill also included substantial corporate depreciation incentives supporting capital investment. We expect 2026 to be another strong year for AI, data center, and power generation investment, but investment could also expand into other areas of construction and manufacturing. We continue to believe that broad economic growth has supported and can support more broad participation in market gains, which means that market leadership could rotate away from the large company technology leaders and move to sectors and companies that have lagged in recent periods. We don't believe that the gains in the technology sector will end, but investors should diversify positions and increase exposure to economically exposed cyclical sectors. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.